Okay, perhaps this is all just a weird coincidence, but listen to this over the next 30 seconds. Sven Hendrick writes this on X. It could be the biggest combination of coincidences ever, but nevertheless, it is a freak show. Comparing 2007 to 2024. The S&P made a summer high in July on the same date. The Fed cut rates in September on the same date. That was September 18th in 2007, as well as 2024. The Fed started with 50 basis points, which in and of itself is pretty rare, let alone to be on the same date. And then the SPX made a new high in October. That was on October 9th. And then the S&P 500 made a new all-time high today on October 11th, the same day that markets peaked in 2007. In fact, October 11th, 2007 was the high of the market for many years following. You actually did not hit a new all-time high until February of 2013. So this was essentially 6 years of the S&P 500 trading down and then sideways. Now, do I think we're going to have almost another lost decade here? Probably not, but the coincidences are getting crazy. Even consider today, the S&P 500 hit a high of 580, which is 5,800 on the SPX. That's a pretty even round number. It will be interesting to see if we can make another new all-time high. Then that would kind of break the trend of weird coincidences. But it's really gonna depend how Q3 earnings go. If we do see these earnings come in good, and if there's less fears about the consumer, then that could power markets higher, but it's really gonna be choppy, I think, this earnings season. Let me know your thoughts on this weird string of coincidences that makes 2007 very much resemble 2024, or vice versa. What's also very weird about this market is at the same time the S&P continues to go higher, earnings estimates are hitting the lowest point they have been at for 2024 earnings over the past couple of years. You're actually hitting now an estimate of $239.49, which is the lowest you have been at ever. And you have 2025 earnings that are at $273.20. These are estimates. This is the lowest level since at least April of 2024. So just so everyone is familiar, stocks tend to go up, markets tend to go up when earnings estimates go up. Stocks tend to fall and go down when earnings estimates go down. And earnings estimates are going down, but stocks are not, which is very unusual. Which really leads me to the ultimate conclusion. This is probably a bit of a short squeeze and a lot of capitulation that is going on with the soft landing narrative being thrown around left and right. Some people on Wall Street are saying, we just gotta go out and buy. We just can't sit out this market. In other words, I think there's a bit of FOMO that is starting to kick in. Now, could that propel markets higher? Of course, but with the fundamental backdrop of lower earnings estimates that keep going lower every single day, it does create a larger gap of disparity, meaning that if earnings disappoint, if economic data disappoints, you could see a rapid correction of this disparity, which is just growing larger and larger by the day. Think about this like the outperformance you've seen of big tech versus small caps for like 3 years. Small caps did very little of anything. They did basically nothing. And large cap tech outperformed massively. And then what happened? You had a CPI report that came in at 0.06%. It came in well below anyone's expectations. It was a 6 sigma event. It was a 1 in 6 million chance. And it happened. And what happened was small caps caught up to the performance of mega cap tech within like 3 trading days. Okay, if you get a downside surprise with the kind of gap that we have widening in markets, you could see a catch down in markets that is very aggressive. I think that is the risk. That's not the conclusion, but that is the risk that markets are facing over the next couple of weeks. and really the next couple of months, but I say the next couple of weeks because we're going to start to get major companies reporting earnings. And if they start to give us bad guidance, a bad outlook for 2025, then that's where you're going to start to see that maybe disparity close up a little bit. Now, as far as the earnings lineup for next week, keep in mind markets are closed on Monday. Tuesday, you're going to have Walgreens, United Health Group, Citi, Bank of America, Johnson & Johnson, Progressive, Charles Schwab, Goldman Sachs, PNC, and State Street that report earnings Tuesday morning. Tuesday and after hours, you have United Healthcare, Interactive Brokers, JB Hunt, Pinnacle, as well as some others. Wednesday in pre-market, you have ASML. That's one of those AI stocks you definitely want to watch for. Morgan Stanley, Abbott, US Bank Corp, Citizens, First Horizon, Synchrony, First Community Bank Corp, and some others. Wednesday and after hours, Alcoa, Kinder Morgan, PPG, CSX, Steel Dynamics, Discover, and Equifax. Thursday pre-market, and Thursday's really going to be your big day. You have TSMC, Travelers, Huntington, Elevance Health, the Blackstone Group, M&T Bank, and some others. Tuesday and after hours, you have Netflix, Intuitive Surgical, WD-40, Crown, First National Bank, and others. Friday, you have Comerica, SLB, and American Express, as well as Fifth Third Bank and Ally. What we heard today from Wells Fargo, they said consumer spending is down a little bit from earlier this year, but overall remains solid. And JP Morgan's chief financial officer said consumers are fine and on strong footing. Now, I want to pay particular focus and attention to Q3 earnings because, again, the government data is just not accurate. It's just not. This is the least accurate government data factually we have ever had before. You have the lowest reporting of government data ever, meaning that businesses, they're really not reporting much to the government. So it's all very inaccurate estimates. And Jerome Powell and Fed officials have also expressed concern that the economic data is just not that accurate. And you're seeing weird things like 750,000 government jobs just being added out of nowhere. Like some of these things, you just gotta kind of look at suspiciously. They're kind of suspicious, right? Let's just be honest. Let's be factual there. And then the Fed, they're incentivized to lie to you. Like they have no obligation to tell you the truth. It's not in their mandate. And the last thing they would do if the economy is really in a bad place is tell you the economy is in a bad place, because then they're going to create a problem in which they would like to avoid. So from the government, from the Fed, you really can't trust anything they say. You got to take it with a grain of salt. But company earnings, they are obligated to be factual, accurate, and honest. Company executives are not allowed to lie to you willingly or knowingly. Now, things on company earnings calls, for an example, they always say at the start of the earnings call, these statements are subject to change and their reliability cannot be accurate upon this, after this date, right? They give you that disclaimer at the beginning, but generally speaking, they're not allowed to lie to you in good faith. They will go to prison if they do. So I think company earnings are going to be really important for this market and the main driver of now until year end at the bare minimum. But I will say with earnings estimates coming down, it is lowering the bar for companies heading into company earnings. And if markets don't respond negatively to that, it could be a big positive surprise from earnings as well. I think the bigger question is what happens to 2025 earnings estimates. Even though analysts are lowering estimates for the rest of this year, that doesn't matter too much. What matters is 2025, and 2025 earnings estimates are coming down. They have been coming down for the last couple of weeks, but if they come down more after Q3 earnings, that's where you likely get the downside for broader markets. Liz Young-Thomas kind of reiterates this same point. She writes on X, over the last 2 weeks, stocks and treasury yields are both up considerably, another sign that growth dynamics are acting as the primary driver of price action. Zero Hedge on X writes from Goldman Sachs. Goldman says, the SPX closed at an all-time high of 5,792 as the VIX spot closed at 21. This is extremely rare. And you could see this here. This has not happened in a long time where you have the fear gauge, the VIX, that is sitting at 20, right? 20.5 or so today. It's down a little bit. Very elevated levels, and the markets just continue to rip higher. Again, it's like We're just waiting around to see what's going on. Why is the VIX elevated? Why is stocks continuing to go higher? Stocks are making a new high. Does anyone else see this? Is something coming? There's a lot of nervousness under the surface, and there is a lot of firms that want that downside protection right now. And just to kind of show you the strength of this bull market, over the past 2 years, the S&P 500 is up 60%. This ranks in the 95th percentile relative to all other 2-year periods. So maybe to put this in a way that's a little bit easier to understand, that you can wrap your mind around, only 1 out of 20 other 2-year periods have been this strong. Only about 5% of 2-year periods for the S&P have been this strong. Or in other words, 19 out of 20 other 2-year periods have not been this strong. This is really an outlier market. Now, other outlier markets would be the rebound that you've seen after 2009 recession, the rebound that you've seen after the 2020 crash, the 1975 rebound after the 74 recession, the 1950s rally, 2000 rally. This is getting up there. Could it extend further? Yes, but you're already extended. Now, we did get news today from Sky News that Israeli response may include a cyber attack on important Iranian facilities separate from military response. And this is kind of weird, because then you also have Sky News that is reporting Biden was not satisfied after his call with Netanyahu ended regarding the Israeli response to Tehran. So what does this mean? We know that Biden has urged Israel not to attack energy infrastructure, not to attack nuclear facilities, and Iran said they're not expected or going to attack nuclear facilities, but they did not rule out oil production capabilities. And I think the Biden administration would be quite dissatisfied with an attack on oil infrastructure in Iran, because that would cause oil prices to spike and that would cause economic pain everywhere. But really, right now for America, that's the last thing you need before an election, is a spike in energy. So I think there's some fears of Israel striking Iran's oil capabilities. And that is what could be a gray swan event for markets. And it could explain why the VIX is trading where it is. And an Israeli official to Washington Post said voting to strike Iran does not require a meeting and can be done by phone at any time. So basically saying you may not get much warning when we attack Iran. And it's kind of interesting, markets did go higher today following again core CPI that came out this week, because it was the 3rd month in a row of a rise to super core inflation, which is not a great sign. David Marlin on X writes, "It is not typical to see the SPX rally into election day when the polls are this close. Trading activity has been very low so far this October, suggesting many are in wait and see mode with Q3 earnings and the election on deck." And typically when investors are in this wait and see mode, they're taking this, patient approach. You do tend to see markets move higher, because markets tend to go in the path of least resistance. And the path of least resistance at this point, until we get bad news, until we get something else, another shoe to drop, seems to be higher. Now, what does all of this mean for Tesla stock? Following this robo-taxi event, disaster, disappointment, whatever terminology we want to use, kind of fits what we got. I don't think anything is certain right now, and I want to stress that. The soft landing's not certain, a hard landing's not certain, what the Fed's going to do is not certain. All of these things are going to change data point by data point, earnings report by earnings report. We could have one earnings report that causes markets to tank. We could have another one that causes markets to rally, but we do know the underlying backdrop of this market. Earnings estimates are coming down. If they continue to come down, that gap is growing between stocks going up, earnings estimates coming down, and you tend to see these things revert back in the middle at some point. Okay, as you are getting what looks like exuberance in markets going higher for no reason at all, in spite of these risks that we have, it is a growing issue that we are rapidly mispricing where economic activity, growth, and earnings will be for next year. that can turn out to be a bit of a problem. And I expect there will be a bit of a problem in that regard between now and the end of next year. Thus, if you're an investor in Tesla, yes, Tesla did not have a great day today, but it doesn't have to continue to have bad days either. I think you've kind of re-rated for this failure of an event, given the top that we had in early October until now. You're down 17.5%. At the low of the day today, you were down 19%. I think you've re-rated for that, so I don't think Tesla needs to see downside in any kind of material way via Tesla specifically. We have Tesla earnings coming up, although we get Tesla deliveries, so as long as margins did not get destroyed, then, you know, that should be a neutral or positive catalyst. What really matters from this point on is what happens in the economy. Does the economy get better? Does it get worse? Does things keep going as they have been? As I've said, long-standing here on this channel ever since August, I really wasn't concerned about a larger market crash between then, August, and the election. And we really haven't seen that. We've seen a couple down days, but generally it's been this FOMO attitude to get into markets. Now, after the election, I think is where things can get a little bit more dicey. I think that's when economic data may start to come in a little bit more accurate, and maybe some of the slowdown that we are seeing and feeling in the economy will be reflected in the economic data. At that point, that's where we're in a bigger problem. So I don't think the coast is clear at all in either direction. I don't think the coast is clear to the upside. I don't think the coast is clear to the downside. And I think you want to be nimble. You want to be prepared, ready to act in either direction. The best way to do that is to have as much cash as possible. Now, if you want to be invested in markets, in which I am, I haven't sold anything that I've owned for the long term, but I have raised cash. I'm not putting as much money to work right now as I have done in the past. I'm, you know, out of 100% of the money I was putting to work in the past, I'm putting like 30% of it to work now. I'm keeping 70% in cash ready to go. The areas that I do see as value are areas that will benefit and re-rate to the upside if we do have a soft landing, which I think a soft landing is maybe 30-35% likely. I think a recession's like 60-65% likely, okay? Maybe 70% likely. The areas that will re-rate to the upside if we do see the economy actually achieve a soft landing and spending behaviors start to pick up are the cyclical areas. They are high-paying dividend stocks. They are, you know, Dollar General, Tesla, manufacturers, right? Industrials, you know, high-paying dividend companies like a Whirlpool, right? Pays you almost 7% dividend. That's really dependent on the economy doing well. Some of these stocks will benefit way more than the headline S&P if we avoid a recession. PayPal even, right? If you want to get into something with maybe a little bit more growth, new management, maybe some more upside. These are the areas. They're boring companies. They're boring stocks. There's times in markets where boring stocks are, you know, value and not the right areas to be in. Like 2022, for an example. You probably wanted to buy big tech. You wanted to buy Netflix and Facebook when it got beaten down. Right now, does big tech look attractive? Absolutely not. It's priced for perfection. So if you want to be allocated to this market, which I think you should be because we never know what's going to happen, unfortunately, it's the boring areas, minus Tesla. I don't think Tesla's boring at all, that have the value right now. Tesla, yes, at 218 looks better to me than it was a couple days ago in the 260s, right? If you wanted Tesla then, I think you should want Tesla even more now. And I think buying Tesla now, if you are in the soft landing camp, makes a whole lot of sense. If you're a little bit more uncertain like myself and you think there's a higher odds of a recession than the markets think, and you think markets will accurately reflect that at some point and come down over the next couple of weeks or months, then maybe just waiting with cash makes sense right now. But I think a combination of both, buying the boring companies, buying Tesla, but keeping more cash on the sideline makes the most sense to me personally. It's not financial advice. This is not a recommendation. If you guys want to come join the trading community, get access to all the trades that I'm making in real time, check out that link down below in the description of this video. We will not miss the pivot. We will not miss the broadening, right? The soft landing broadening that we will see in markets. If you think it's started, you haven't seen shit yet. If there's a soft landing, there will be a massive broadening out of markets. You haven't missed anything yet. if we go into a recession or a recessionary-like economy. We haven't seen anything yet. Markets are going to fall a lot. I will not miss that pivot is what I'm saying. So if you guys would like to come join us and not miss out, check out that link down below in the description of this video. Obviously, nothing is a financial guarantee, and you can lose money if you don't take accountable risk management practices and hold yourself accountable. Don't hold me accountable. Hold yourself accountable. You do not have to trade anything that I trade. And I recommend that you probably don't. You use those strategies that I am employing to come to your own conclusions. Maybe you want to inverse me if you don't agree with me. Who knows? Whatever, floats your boat. Nonetheless, that is it. You guys enjoy the rest of your day, and I will see you in the next one.